everybody.
I'm Sean.
Kelly.
And this is this week's market report.
I get to do this one.
Yes, what's our challenge
the
today?
hook is, what the cuss? Interest rates are the highest they've been since 2002.
This is my thumbnail.
Almost 20 years.
That's pretty high. Yeah, what did it go? 7.09?
09, 7.0, the big old 09.
The big old 09. So yes, the interest rates have gone up yet again to 7.09%. So we're going to talk about...
They were 7.13 in 2002.
That was okay. Yeah, and they've been hovering the last like 4 or 5 days at about 6.96. So they've been easing up and then flatlining, but yeah, they went up. So we're going to talk about what do we do about this? Okay,
Yeah.
how
Why
does this affect
it's
us?
still okay.
Yes. Okay, here's what's going to happen. All right, if the market starts to slow down a little bit because of these interest rates, this would be another opportunity. We've been trying to tell and present these opportunities as they've been coming up.
I'm sorry.
As they've been coming up. What's happened is we've seen, as interest rates have gone up, we've seen buyer demand in a brief period of time will come down and presents an opportunity. But the reason that presents an opportunity is because buyers are pulling back because they're waiting for interest rates to come out, or come back down. So what that creates for you as a buyer is the opportunity to get a property without spending $30,000, $40,000, $50,000 more with the multiple offer situation in the bidding.
Which is what we've been having happen again and waiving all contingencies.
So let's take this as an opportunity. We will watch our market report each week. And if we see this coming down in a buyer's market, it's only going to do it for a short period of time. Jump on the opportunity in serious. And these are the strategies that you can do to still utilize and buy the property.
If we haven't lost you already, don't decide that, oh yeah, I don't need to hear any more of this. Like lenders are giving you ways to make this an easier situation for you to get into a house right now.
Yeah, so the opportunity may not present itself, but if it does, be ready to jump and don't miss this window because it's going to go right back up again as far as demand. Okay, so what are our opportunities here?
Okay, so lenders are offering a few things. One, ARMs. Are coming back into fashion, as well they should right now. An ARM is an adjustable rate mortgage. It's also a VRM, you might hear your lender say, which is a variable rate mortgage. So it's kind of like this. If you've heard like of a 5-1 ARM or a 3-1 ARM, do you want to explain what that is?
No, that's you. That's the lending.
This is my job. So essentially, a 5-1 ARM, for example, your rate is going to be the same, lower than market, than what you would normally get for the first 5 years, and then it's going to adjust every year after that. So that's the 5-1 stays the same for the first 5 years. The 1 adjusts every 1 year after, and there might be a 5-2 where it adjusts every 2 years after, and that's going to be based on an index. So it'll adjust the margin, like maybe a 3% margin based on an index, which is going to be like the SOFR, the WSJ.
Correct me if I'm wrong, but the goal for that would be you get the lower rate now while the interest rates are kind of going up and down.
Right.
But over the long term, somewhere within that 5 years, if the rates come down, you could refinance out of it.
Right. That's exactly right.
Yeah. So that's
you can always refinance within 6 months, which brings us to number 2. Some lenders, not all, some are offering
refinance without closing costs.
Yeah.
So that's the big expense of refinancing, is that you have another set of closing costs. They do get financed into the loan, but it is an expense that you have to calculate into your strategy. But some lenders, recognizing that demand is going to go down a little bit because of the high interest rates, are offering no closing cost refinances.
That's really
that's
great.
Significant, because then anytime after 6 months you can refinance and not have that added expense. So that really takes the risk out of it for you.
Yeah.
Yep. Yeah. So that's the classic. Just a quick second. Date the rate, marry the house. Right. So you buy the house, you get the sales price.
I like that.
You may have to pay more on your interest rate, but then, assuming 6 months from now, the rates do come down, assuming you can still qualify it, you refinance it at no charge, and now you've got a lower rate and a lower priced house. So it's a great opportunity. Okay. All right, what's the next step?
Okay, well, I want to talk about one of my very favorite things, if you can manage it, and I'm skipping 3 for you because I want to talk about my favorite one. It's where you buy points to buy your rate down. There's a limit on how far down you can buy your rate, but this is excellent. So here's how it works. At settlement, at closing, you would pay 1% of your loan amount for every quarter point you want to lower your rate. So here's the example. Let's say your loan amount, not the sales price, but the loan amount is $500,000. So 1% of that's $5,000. So at settlement, you would pay $5,000, and that would lower your rate. Say it was 7%, it would lower it to 6.75%. You pay $10,000 to make it 6.5%. But that is beautiful. I love it. And one of the really amazing things, maybe not so much in our market at this point or any other hot markets, but you can oftentimes get seller subsidies, and that will cover the cost to buy these points, and you're buying yourself a lower rate. So I love that.
That's a really good point, because when the interest rates first started going up last year, we had a lot of sellers offering buy downs and offering points. So if demand does slow down, that might be something that can be negotiated in this market right now. We're not seeing that anymore because it's a strong seller market. Yeah, but that's something we can always play with. Yeah.
And you mentioned the buy down, which is different than buying points.
Yeah,
so that's the last thing.
So you can do a lot of lenders will offer, like, let's say a 2-1 buy down, and where I don't remember the exact details, you may correct me on that, but basically where you can buy down the rate for 2 years. You can basically prepay for the interest for 2 years, and then at the end of that 2 years, the rate would go to the current market interest. And that's another thing that sellers were offering. That gives you time, hopefully, for the rates to come back down and you can refinance.
Or let's say the other time this works great is even if, because, the ability to refinance is if you can, if it makes sense. But let's say you're expecting a good job promotion in a year, 2 years, 3 years. A buy down then is really, really excellent. Sometimes you have a situation where maybe one partner in the household, they couldn't use their income to qualify. Maybe they were new on their job, but at the end of this buy down term, they'd be able to use that, and then it would be amazing. So there are all kinds of scenarios where a buy down is a really great idea.
So basically what we're saying here is the tendency when this happens is for buyers is you want to pull back because you're always looking for the perfect market environment. And the smart buyers, the investors, the people that know how money works, they don't follow the herd, they go the opposite. So when people are pulling back, that's when you go into the market and buy. You overcome the obstacle, one of these strategies or some other plan that we can help you come up with. You overcome those obstacles so you can get the property at a much less expensive price because you're not having to fight 15 other buyers in a multiple offer situation. So this could be an opportunity. This could be a fantastic time to buy. You're
really not, I want to hit on that, right? So you're not really ever going to meet the unicorn face to face where the prices are amazing and the rates are amazing and it's not a seller's market. It's not going to happen. And one of the things that I know in our financial relationship together, I've had to learn and wrap my head around.
You got 4 of them. We keep the rest of them down low.
Personalities going on in here. That's not too far from the truth. But is seeing money the way you do, is your money is a tool. It's not your foundation. It is not your faith. It's not your everything. Money is not your everything. It's just one of the many, many tools. And we're here to help you use your tool to the best of the ability in the environment in which you find yourself.
All right, so let's get to the market report, see what's going on, and see if there's any advantage that's happening right now. All right, so let's get to the numbers for the past 7 days, see what's been happening in the market. I will tell you that the pulse of the market, no matter what the numbers show us, the pulse of the market has been that properties are still moving quickly, still getting multiple offers, so long as they're priced right and priced for their condition. We've had some buyers that have been in several different instances that have gone up against several offers with escalation clauses and removal of contingencies, as well as we've had sellers that have gone under contract even in the coming soon phase with sight unseen offers. So it is still a very competitive market. The volume of the market is down. And actually, the buyer activity seems to be down a little bit statistically, but it's not coming through with the properties that are priced appropriately and that are in the condition, priced appropriately for the condition, because as soon as they hit the market, there are enough buyers out there to create that demand. So we're still seeing that pretty strong seller's market. So let's dive into the numbers and see what that looks like. So as always, our orange line is our buyer activity. This is our demand. And our blue line is inventory. This is our supply. And the determination of whether it's a seller's market or a buyer's market is how much higher is this orange line versus the blue line. If this was reversed, as it was for here, for example, where inventory was higher than demand, then we would dip down into a little bit of a buyer's market. But for the most part, throughout the entire year, we've seen that the demand has been much higher than the supply. So because of this gap right here, that's the buyer activity or the demand. This is the seller activity or supply. Because of this gap, if you go over here, you will see that we are in a strong seller's market. Now, it does vary week by week because you can see inventory will kind of come up and go down, and buyer activity responds accordingly. So we can dip down into a buyer's market every once in a while, but if you look at the general trend, for the last several months, we've been in a pretty steady seller's market. And we don't see that changing because we're seeing inventory starting to drop as we get into the fall. And even though buyer activity seems to be coming down a little bit, so is inventory. So that still maintains that stronger demand versus supply ratio, which means that we should stay in a strong or pretty strong seller's market as we move forward. What does this mean for you if you're out there as a buyer? It means that you need to be very strategic with your offers. You need to get with your agent, figure out how to best strengthen your offer within your risk tolerance, and then put your best foot forward if you really want the property. Do everything you can to get that property, again, within your risk tolerance, and make sure that you understand the risks for waiving certain contingencies, the risk versus benefit reward. On the seller side, it's a great time to sell. There's very little inventory, so you don't have a lot of competition, and as long as you price your property correctly, and when you're looking at your property and you're pricing it, don't price it simply based on size, square footage, and so on. It has to also be priced according to condition. So if your condition of your property is not great, you need to price that appropriately because the buyers are looking for turnkey properties. If they're going to have to put any money into the property, they are expecting that property or that seller to adjust the price accordingly. So buyers are not as free with the money as they were back when interest rates were 2.5%, but there is still a lot of demand, so there is still the opportunity to get above asking price and above market value. All right, if you have any questions or you want to talk about your situation individually, please feel free to reach out to Kelly and me, and we will be happy to jump on a call with you. All right, we'll see you next week. Good luck out there and have a great weekend.